Sorry about that. I was on mute. Let's start again. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And today's show is about something that really caught my attention. You are going to want to pay special attention to this show. Imagine this. You're sitting in your home, and everything is going great. You're paying your mortgage on time, and a bunch of people show up outside your house, and within a few minutes, they stick up an orange notice on your house that you're current on your mortgage on. I mean, current. And they just told you that they just foreclosed on your house, and you have 72 hours to leave it. This show is on zombie mortgages and how they can steal your home from you and all of the equity that you have acquired over the years. You don't want to miss this show. Tune in and tell your friends. Let's go. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And for 19 years, we've been sharing this kind of information with people, not just in this country, but around the world, telling them that they don't have to pay all of that interest to the bank. They can cut their interest costs by about 75% and pay off all of your debt in an average of 7 to 9 years. And what's great about this, ladies and gentlemen, you don't have to, what? Sacrifice lifestyle. You can live well, manage your debt, get out of debt in about 7 years, grow your savings at the same time, and live well while you're doing it. Oh my gosh, this is going to be a good show today. I see Key Solutions coming there saying, good morning, Mr. Daniel. Good morning to you, Key Solutions. Listen, anybody else that's out there, go ahead and say good morning. Listen, I want to shout you out. Tell me where you're watching from, and I want to shout that out too. But listen, let's put this on the screen so we can jump right in. All right. So listen, I got this idea. This came to me from a podcast. All right. So let me scroll up to the top here. The podcast is called Planet Money. Okay. And we're going to put the link to that podcast in here in just a second, to Planet Money, so that you can get this show. I got this show. Here it is. Let me tell you a little bit about this. I'm going to make this a little bit bigger. All right. So we're going to be going over a lot of information today. Get your notepad ready. You're going to want to get this information. Okay. So I'm going to make this just a little bit bigger here. All right. There we go. This is about Karen. This story is about Karen McDonough in Quincy, Massachusetts. Listen, it says here she was enjoying her tea one morning in the dining room when she saw something odd outside her window. A group of people gathering on her lawn. A man with a clipboard told her that her home no longer belonged to her. Can you imagine that? She was current on her mortgage. All right, Key Solutions from Washington State, you really are going to enjoy this one. Okay. It told her that her home no longer belonged to her. It didn't matter that she'd been paying her mortgage for 17 years and she was current on it. She was a nurse with a good job and raised her kids in that home. But this was a foreclosure sale and she was going to lose her home. This caught my attention. I wanted to know what a zombie mortgage was, and was it actually a thing? zombie mortgages. So let's dig into this thing and see what we can do. Now, let me tell you, whenever you are faced with a stressful situation like she was, here are a couple of things that you definitely want to do. Call someone who can help you. And I guarantee you this, do not call your bank, do not call your mortgage company, because that's what she did. She called the mortgage company and they told her that that second mortgage that she had was no longer in existence. Don't worry about it. These people that are outside there that are calling you, it's probably a scam. She says, they said, stop talking to them. Don't even bother. And she did. Do not call your bank or mortgage company. The people who answer the phone are not expert in the laws that govern this thing. They're not even expert in how a mortgage actually works. They're not expert in any of that. Please do not call them. And some of you have actually called, some of you have been watching this show for a while and called your bank to see if some of the things that we're teaching here are true. And none of them were able to talk to you about intelligently about how a mortgage works. And some of them probably even told you that what I'm teaching here doesn't even work. But you see the math for yourself. So here's what I need you to do. Call somebody who knows. You need to call a lawyer, right? That knows about how all of this works. And we're going to give you some resources today so that you can get to the information you can get to if you want to understand what's happening. So what happened here in a nutshell? Okay. In just prior to 2008 and the mortgage meltdown, one of the things that mortgage companies were doing so that they can sell more mortgages was to provide you with what's called an 80-20 mortgage, an 80-20 mortgage. So to make sure that you can get under have the right amount of debt, your debt to income, you have to have you can't get a 100, you couldn't get a 100% mortgage, but you could get 80%. So here's what they were doing. Get an 80% first mortgage and then put a second mortgage on for 20%. And that way you're under that threshold and then you could qualify for the loan. So you go in with an 80-20 loan. The 80% loan was in the regular mortgage was in first position, and the 20% was in second position. So when the mortgages started to collapse, people couldn't pay these mortgages, and the whole thing started falling apart and caused the recession. The property values started to plummet. And when the property values start to plummet, when you have an opportunity to try to save your home and try to refinance, but guess what? If the values go down, you cannot refinance out of that loan because there's no equity. And when you have a mortgage in the first position and in the second position, you always satisfy the first position first. They get paid first. If there's not enough money, then the second position has to wait. And the property values fell so much that the government stepped in and said, here's some things you can do. Now, some of you may know someone, or maybe even you received a modification for your loan. you had your loans modified. Okay. And by modifying that first loan, there still was not enough money to satisfy the second mortgage. So a lot of these companies wrote the second mortgage off. And then you were told that that second mortgage has been written off. You don't owe it anymore. That's what you were told. That's what she was told. She was told she didn't have to pay that anymore because the company wrote it off. So we're going to find out that it wasn't actually, it was written off, but it wasn't dead. These companies packaged up all of these mortgages they could not collect on anymore and sold them to investors. And they bought these mortgages for pennies on the dollar. I mean, there are people out there buying these mortgages up, these second mortgages. I mean, 100, 200, 300, maybe even in the thousands of these mortgages, and only spending about $500 to $1,000 on a bunch of them because they weren't to the companies. They weren't worth anything anymore. But guess what? They said, we're going to sit on these things and see what happens. And what has recently happened to your property values? They have begun to skyrocket as of 2020, COVID, and we didn't have enough houses. And remember that time when the housing prices shot up because there weren't enough houses out there, and people were overbidding on these houses, and it was going crazy out there. So these houses have increased in value. So these people who bought up these cheap mortgages have come back and said, I own the second mortgage on this house. You owe me money. And the people were told that these mortgages were dead, so they weren't listening. But in fact, these people may have a legal claim and they can go to court and get your house for the little amount of money that's in the second mortgage. And if you can't pay it, they can take your house even though you're current on the first mortgage. How about that? We're going to dig into here. We're going to dig in and see what we could do about this. So here's the first place you want to go to get information. TILA, Truth in Lending Act. Truth in Lending Act. We're going to put that in the chat here. You want to see that. Truth in Lending Act. We're going to put that in the government agency so you can dive into this. Now, here's what I'm trying to tell all of you today. Okay. We are not lawyers here at the P.I.L.L Method. We're just pointing out what you can do. Please consult legal representation on all of this, because even though you can go into the website and start digging around and finding information, if this should happen to you and you only have 72 hours to try to come up with a solution, trying to dig through the government website probably is not the thing to do. Okay. You want to get ahead of this thing, and we're going to give you some things to do just in case this happens to you, how you can be in a better position. We're going to go over that today. So that's the first website. Okay. That is Truth in Lending. All right. Here's the other one. CFPB, the Consumer Financial Protection Bureau. All of these things are set up for you. Okay. All right. Okay. Is somebody on? Okay. There we go. All right. So we're starting from the top and going down. All right. And then we've got the CFPB government website. Here it is. All right. And you can read through this to get good information about how these second mortgages actually work. If you had an 80-20 loan prior to 2008, and you were told that that second mortgage is no longer in existence, you need to pay special attention to this show and get this information. All right. So now me, I'm not very good at researching, but there are people out there that are good at researching, and they can put information together for you to save you some time. And here is the next thing you want to see. All right. There we are. It's called let me see, NCLC Digital Library, the National Consumer Law Center. This is not, I repeat, this is not a governmental agency. These are a bunch of lawyers, okay, that specialize in helping people fight against bad actors in the banking industry. Okay, so you want to definitely get this information and help. And in fact, you can actually subscribe to their library and get a lot of good information. But here is what I want to, you definitely want to go through this today. So can I share something with you here? Let's scroll down through here. It says, what are zombie mortgages? We're going to go through this. I need to make it bigger, not smaller. Right, here we are. As the name suggests, zombie mortgages can be terrifying. They rise from the dead, appear without warning, and seize homes. Okay, now, some of this happens because we believe that the people outside with all the paperwork have a right to our home, and that may not be true. As we get into this thing, you need to always do this. Take a breath, don't get excited, and find someone who knows the truth. Because these people, if they tell you that they now own your home and you have to get out, and you believe them, they win. Here's what you do. Stay in your house. Continue to make your mortgage payments on time. Stay in the house. Don't get out. Continue to make your mortgage payments on time and contact legal representation. That is going to be your key to getting out of this, because there's a lot going on that we may not know about. So let's dig in a little bit. This article explains what they are, why they are now such a problem, and 12 ways homeowners can stop foreclosures on zombie mortgages. Oh my gosh. Is that what you want to know? How can you stop this if you need to? 12 ways to stop this. This is what the young lady did not have that was in the podcast. It was featured on that podcast. So what are zombie mortgages? Here we go. Zombie mortgages that are wreaking havoc today are second mortgages. Many were originated by predatory lenders in the years leading up to the 2007 financial crisis. During that era of frenzied lending, brokers often combined first and second mortgages in a single loan transaction. There were two loans, but it was a single transaction, referred to as 80-20 mortgages. Now, on the face of it, there's nothing wrong with an 80-20 mortgage. On the face of it, okay? But when you have a financial crisis, it could become a problem later. So let's get this on the record. Nothing wrong with 80-20 mortgages, all right? The transactions typically finance 80% of the principal balance through a first mortgage and the other 20% through the second mortgage. This kept the first mortgage within a loan to value ratio for easy securitization. Let's stop right there. What is securitization. Most loans, let me see if I can find that for you. We mortgage-backed securities. I have let me get this link here on mortgage-backed securities. You want to see this. So we're going to copy that. All right, we're going to put this here. And we also have that link for you as well. Mortgage-backed securities. Okay. Now, some of this you did not know, but it happens to everybody. Mortgage-backed securities are debt obligations that represent claims to the cash flows from pools of mortgage loans, most commonly on residential property. Mortgage loans are purchased from banks, mortgage companies, and other originators, and then assembled into pools by the government, quasi-governmental, like Fannie Mae and Freddie Mac. They're quasi-governmental, and private entities. They, the entity that issues securities that represent claims on the principal and interest payments made by borrowers on the loans in the pool, a process known as securitization. So these are mortgage-backed securities. These are instruments made up of dozens upon dozens of mortgages that people invest in. So within a week or two of you closing on your mortgage, 70 to 80% of those mortgages are sold within that time. Some of you have even gotten notification that your mortgage has been sold several times. So this is how banks really make their money. They don't make their money on the interest from your loans. If Wells Fargo, Chase, Regions, Citibank, wherever you get your mortgage, they're not making money off the interest. They make their money back within a week or two after the mortgage closes and investors buy your mortgage. And you're saying, well, Don, I still pay Chase. I still pay Bank of America. I still pay Wells Fargo. That may be true. But if you call them today, if you call them tomorrow and ask, who holds the note on my mortgage, they may tell you it ain't us, it's somebody else. We're just collecting the money for them. So you continue to send the money to us, but somebody else owns your mortgage. I found this out because I had a mortgage with Regions here in Huntsville, Alabama. And when during the during COVID and everything was going crazy, I actually called them to find out what was going on. And then I don't know how it happened, but accidentally I found out that even though I was paying Regions didn't own the mortgage anymore. Somebody else did. There you go. So it's happening all the time. This is how this system works. This is the American system of mortgages, where banks can be, a bank that has millions of mortgages, they don't have enough money to lend on all of those mortgages. So what they do is they set up a mortgage and then they sell it at a premium to investors. And that's how they get their money back, plus their profit at the time they sell it. Okay, so that's what's happening. So there are certain things that are going on behind the scenes there. All right, so let's get back to where we were. Let me see. There we go. All right, zombie mortgages. Okay, why did these second mortgages become dormant? All right, this is key here. Many homeowners struggled to keep up with their first mortgages through the Great Recession, often with the help of loan modifications. In the early years of the recession, home values dropped precipitously. With so many properties deep underwater, holders of the first mortgages faced reduced recoveries if they foreclosed. Okay, so here what I know there were so many foreclosures at that time. I know people who were foreclosed on, but the bank never asked them to leave the house because there were so many foreclosures. That means that the bank had now has to maintain that property. If they let you stay in it, even though you weren't paying, you still maintain the property. You still cut the grass. You still took care of it. And they were hoping that when things got better, they would come back and then ask you to leave because now you may have some equity in the house again. So keep that in mind. We got to the point where there was no equity. Investors and bankers are waiting until things get better, and then equity increases as the property values start to increase. Keep that in mind. All right. Second mortgagees, on the other hand, were almost certain to obtain nothing. If you can't get anything for the first mortgage, you certainly aren't going to get anything for the second. That is a fact. Okay. On the other hand, they were almost certain to obtain nothing if they decided to foreclose. Not surprisingly, as many homeowners were unable to make payments on second mortgages, the owners of these loans wrote them off. You see, after 3 months or so, you can just write it off. You want to get that off your books. You want to get that debt off your books. It makes your books look better. All right. If you have income, but you don't have all of this debt on here, so they write it off. And then they can get some tax benefits for writing off bad debt. Okay. So everybody was struggling back then. These write-offs were accounting devices used to reflect that the loans had ceased to become had ceased to be income producing assets. So when you call your bank about that, when you're going through the process of saving your home, going through the modification process, and you talked about this second mortgage, what do we do with that? They're telling you, you're barely able to make the payment on this first one. That one is no longer in existence. Kind of true. They wrote it off. It doesn't mean it's dead. Okay, keep that in mind. The accounting adjustment did not necessarily mean that the borrowers were no longer under legal obligations to repay the debts. In most cases, unless some of the legal principles discussed in the article applied, the loan owners retained the option to change their minds and demand payment again. They can change their minds and come after you for money when you have something of value. When you didn't have anything of value, you didn't hear from them. Borrowers did not understand this. Many thought that when their first mortgages were modified, second mortgages were covered as well. Years passed, sometimes well over a decade, 10 years can pass, thinking that these things were dead, and they spring back to life like zombies. Okay. And borrowers heard nothing from anyone about these second mortgages. Here we go. Let's get into it. We're getting deeper into this. Okay. Listen, put some questions. If you have questions about it, get in there and put your questions in. If this is happening to you, please come on the show. Please come on the show. We have a link there that you will be able to see, that you can come on the show and let's talk about it if you have some input into this thing. All right. I'm not an expert on it. I haven't gone through this myself, but if you've gone through it and come out on the other side, great. If you're actually going through it now, come on come on the show. Let's talk about it. You don't have to come on camera. You can just stay on audio. Come on and talk about it. But at least put your questions or comments in the chat. Okay? Why are zombie second mortgages coming back to life now? Okay? Zombie second mortgages are coming back to life for simple economic reasons. Simple economic reasons. If you are an investor in these second mortgages, here's how you're thinking. I need you to focus here and think like an investor for just a couple of minutes. Now there is some equity for them to feed on. Over the past several years, home values rose significantly in many parts of the country. Homes that were underwater in 2010 now stand well above water, and homeowners' equity has become an enticing target. Let me see if I can make this make sense. You have a home now that was bought for $300,000 way back when. And because of increasing property values, and some of you have heard about this, that home could be worth $600,000 now. And I mean a whole ton of equity, a whole ton of it. Somebody can look that up, look in your area and see what the housing values are. They see how much you could have a 50,000 or an 80,000 second mortgage out there that is dormant but not dead. And they said, listen, I got an $80,000 note here that I spent $1,000 to buy. And because I own this now, I'm going after $600,000. I'm going after over $300,000 equity, and I spent $1,000 to buy the paper. That's what's happening. And if you let them get away with it, they will. There are some things that you definitely can do. So I don't want you to think that it is that there's nothing to help you here. All right. So somebody has a question here. Do the second mortgages follow the house or the individuals? For example, if the house is sold, can the second mortgage still come back to collect somehow? Now, the second mortgage is on the house that you bought with the second mortgage. If you move to another house, the second mortgage doesn't move to the next house, but that doesn't mean you don't still owe the money. Okay? It's just that there's no leverage there for them. All right? Unless they want to try to ruin your credit. Let's say everything starts going well with you and now you're making good money. All right? But they can't attack the house, but you still owe the money. They're going to come after you to get the money. Now, if you have equity in this new house, it may be suggested that you take out a line of credit or a second mortgage on the new house to satisfy that old debt. And this is why you need to pay special attention to this show today so that you can fight back if this is happening to you. I hope that answers your question there. Okay, so let me see, where was I? Over the years, since the Great Recession, many homeowners also work to pay down their first mortgages, further increasing their home equity. So I'm putting more money into my home, thinking I'm building equity. Also, market conditions improved, so my house is appreciating. So I'm paying it down and my house is appreciating, and you're feeling pretty good about the equity that you have. Let me stop here because this is a note that I have at this point. If you have equity in your home right now, even if you don't need the money, I want you to listen to me very carefully. If your credit score will support it, start and get a equity line of credit, a HELOC on your current home. Okay? If you have equity, get a HELOC. Let's just say, I'm just throwing out some numbers here. Let's just say you can get a HELOC for like $100,000. It doesn't mean you're borrowing $100,000. That means you're set up to access $100,000 of your equity anytime you need to access it. They're usually good for 10 years, whether you use it or not. So think of a HELOC as a big old credit card, okay? And it is revolving debt. You can literally have $100,000 line of credit, borrow 5,000 of it, and because you borrowed 5,000, you only pay interest on the 5,000 as long as you're using it. As soon as you pay it back, you don't owe anything to the line of credit anymore, but you don't have to take out a new loan. You just use it. You just can use the money over and over again. I hope that makes sense. Good morning, Valerie. I'm glad you're here today. Okay, so get a HELOC. All right, and if you want to get the right HELOC, I need you to do this. You want to call 256-886-1867. 256-886-1867. Call that number, ask for me, and then I can give you a couple of tips on that. But if you want more information, we can dig down deep, and then we'll just set up a consultation. And our consultations are inexpensive, only $150 for the first hour. All right. So we can help you to get you set up in a HELOC within a week or two. They're very fast. They're very cheap. And the banks are itching to set you up with that HELOC today. All right. Whether it's your bank or your credit union, you don't have to get a HELOC from the lender that gave you the mortgage. You can shop around and get good rates. You can get good, you can set that loan up in a way that benefits you most. If you call the P.I.L.L method, we're going to help you set that up in the best way for you. And even here's what you don't want. Don't let the bank educate you on how to get a HELOC. Please don't. Call us. You need somebody on your side when you're doing this, okay? So get the HELOC. And the reason why you want to get the HELOC is if something happens and it turns out, no matter what you do, you contact your lawyer in this situation, and the lawyer says they have a legal claim, you can then maybe use your HELOC to satisfy the debt so you lose your home. Okay? All right. Keep that in mind. And then we'll talk about how to make sure that you can increase the amount of money you have in equity on your loans prematurely. You can accelerate building equity at 5 to 7 times the regular rate using P.I.L.L method strategies so that you can be in a better position. We're going to talk about that in just a few minutes. Okay? That's right. HELOC. All right. HELOC. That's correct. Okay. Yes. I need some help. I have one now, and I need to get a new one to replace it because I have additional equity now. But the banks are saying my DTI is too high. Well, we can talk about that. Let's see how we can get your debt to income ratio in line so that you can get your new HELOC. Okay. We can talk about that. Okay. Make sure you call. Let's have that conversation. All right. So who is foreclosing on these second mortgages? This is crucial. The parties foreclosing on zombie second mortgages are a mix of players. Okay. Let me see here. With the original lender seldom still in the picture. Listen, some of these mortgages have been sold several times since the original lender wrote it off, packaged them up, and sold them for pennies on the dollar. Okay. So they could have changed they could have changed hands 5 or 6 times. So trying to trace it back can be a problem. Right. And that could be a benefit for you. Okay. You'll find out later. All right. Debt buyers purchase pools of defaulted loan accounts. They listen, they salivate over these things because they're so cheap. And what they're hoping is that they can find a nugget of gold amongst all the dirt. And that nugget of gold could be your equity. Okay. Then opportunistically select those who foreclose. Select those to foreclose, meaning they're going to cherry pick. They're going to say which ones are going to be worth the most that we have the least amount into that we can make a huge profit. So they're going to comb through that to find the best ones to attack. Okay. They can focus on equity rich properties and those where they can easily pay off the first mortgage to obtain unencumbered title for themselves. I had to look this up. And what this means is when you have a second mortgage, Lord have mercy. This was scary to me. When you have a second mortgage and they have that second mortgage, do you realize that if they foreclose, they have the right to immediately pay off your first mortgage? So they now own everything. Let me back up here. Because they have the second mortgages are unique in this. First mortgages are not, but second mortgages are unique in this. You have a house that's worth $600,000. They have, and you owe $200,000 on it. Okay. You have a house that's worth $600,000. You owe $200,000. They have a second mortgage worth $80,000. They foreclose on the second mortgage. Then they pay off the $200,000 that you owe. They own the whole thing now. And unless you know what to do about it, they will take that home, or they have the opportunity to rent it out or sell it. And most of them will sell it. Okay. I spent $1,000 to buy $80,000 loan. I foreclosed on the $80,000. I pay off $200,000 on this mortgage. I get a property worth $600,000. Ladies and gentlemen, that is a deal all day for the investors. And some of you are prime targets if you have these zombie second mortgages that you thought were dead. Please get this information and be ready for when it comes. Okay. How does a second foreclosure, how does it work? It works like this. At the foreclosure sale of the first mortgage, the buyer typically acquires title free from any liens that attach to the property after the date of the mortgage originated. They don't have to worry about any other liens. Listen, this is a powerful tool if you own these second mortgages. Okay. In the case of a second mortgage foreclosure, the buyer at the foreclosure sale does not obtain unencumbered title of the property. Now, let's read this part again. All right. The buyer typically acquires title free of any liens that attached to the property after the date of the mortgage originated. In the case of a second mortgage foreclosure, the buyer at the foreclosure sale does not obtain unencumbered title to the property. The buyer acquires only the borrower's right to redeem the property from the first mortgage. Now, listen, if a buyer at the foreclosure sale of a second mortgage wishes to do so, the buyer can pay off the first mortgage and thereby obtain title to the property. Are you hearing me? This is happening. Importantly, the foreclosure of a second mortgage means that the borrower's right to redeem the property by paying off all of the mortgage debts is extinguished. Wow. Under most state laws, the purchaser at the foreclosure sale of a second mortgage can proceed to take possession of the property and evict the borrowers. Needless to say, the ability to use the powerful remedy of foreclosure gives a second mortgage debt buyer and its debt collector extremely powerful leverage. You need leverage of your own. Okay, you need leverage of your own. Explore the substantive distinctions between first and second mortgages. So I went to this site because there's a lot of good legal information in here, and that you can count on. So let's get into here. I want to go over just a couple of things that you can do. 12 ways homeowners can fight off zombie second mortgage foreclosures. We're not going to go over all 12. We're just going to go over some, but we're going to dig into this part after the break. So stick around. Don't go anywhere. We're going to take a quick break, and then we're going to come back and talk about what we can do about these zombie mortgages. Be right back.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, you want to go to ice10k.com, ice10k.com. So, and then scroll down under Dr. Eric Thomas's picture here, the one who paid off his mortgage with our program. And look here, click on where it says get your free savings and earnings report. Once you get this report, you'll know the month, day, and year you could be debt free and how much interest you could save. And usually it's all of your debt in about 7 years. You get the report for free. Just follow the instructions after you click on get a savings and earnings report. And we'll also go into, if it applies to you, we'll also go in for you where you can accelerate your equity, make sure you're in a position to get a HELOC to help protect yourself against these zombie second mortgages if this applies to you. All right. You need to be able to protect yourself. People are coming after your property, and make sure that this doesn't happen to you. Make sure that you're using your equity the way that you need to. Always, always, always get the HELOC when you don't need the money. When you do need the money, that's probably when you can't get it. Okay. So let's be careful of that. Get your savings and earnings report today. Start filling that out today. Go to ice10k.com, click on get a savings and earnings report under Dr. Eric Thomas's picture, and it's free. Okay. So why not learn how you can manage your debt cheaper and get out of debt faster? We're guaranteed that you're going to be able to pay at the least amount of interest that's mathematically possible for you, and no program on the planet can beat us for interest savings, guaranteed. Okay. All right. I look to hear from you guys in this next week. Okay. Great. Let's get back here. So 12. We're going to start diving into what you can do about it. What can we do about it? 12 ways homeowners can fight off zombie second mortgages. This first part is pretty good. Resurrecting a long dormant second mortgage and abruptly threatening to foreclose is a patently abusive practice. When presented with viable defenses and claims, courts should be willing to intervene to protect homeowners. Okay, so it gives you some stuff to click on. This describes legal defenses and claims that give courts authority to rein in zombie foreclosures. Now, remember, this is a paid site. Okay, this is not a government site. This is a paid site, and they're giving you a lot of good information so that you can use their lawyers to help you. This isn't the only company that does this. I just found this one because they gave away a lot of good information that you can use. Okay, that's why I chose this. Okay, so let's get into so they can rein in these zombie foreclosures. This article summarizes the important claims and defenses. Here's one: statute of limitations. When I first started doing this, I didn't even think about the statute of limitations. Now, the statute of limitations you have to check your own state, but the statute of limitations is around 6 years. So if they have not contacted you in those 6 years, they may not have a legal claim. Now, here's the other thing you need to think about. Just because they don't have a legal claim, they can go through the foreclosure procedure. And if you believe them, they can still get your house, even though they did not have a legal claim to get it. It sounds legal. They have paperwork. They went through the courts, because the courts aren't going to ask, how old are the loans? The courts are going to ask, do you have legal right? All they have to prove is they bought your second mortgage. They don't have to even prove when. So if they go through the court system and all of this looks credible, all of it looks legal, and you believe it and leave your house, Lord have mercy, they have just won with something that held absolutely no weight at all. Please contact a lawyer to help you to sort this kind of thing out. And you may find out that in your state, they don't have any legal standing at all. They got to go away. Okay, so get some help here. Here's some other things that you can statute of limitations. It goes into more information on that. Okay, now let's get into number two. Number two, challenging authority to foreclose a second mortgage. Can you imagine somebody shows up with paperwork that says, we bought your house. You have 72 hours to get out. All right. And you say, yeah, not so fast. We're going to challenge this foreclosure. And it's going to strike fear into their heart, because they're going to know, have you been listening to the P.I.L.L method or something? So listen, challenge it. And they're going to give you some information on that. The party foreclosing a second mortgage must have authority to enforce the underlying contractual documents, the note and mortgage. Okay, so there's some information here that even if you click on it, you can only get the heading. You have to pay for the library to actually read these. Okay, provide extensive analysis of the authority to foreclose. Let's get into this thing. The debt buyers who acquire pools of defaulted second mortgages are unlikely to have systems in place that larger mortgage servicers use to document transfers of negotiable notes and account histories. It's important that all of these documents be in place. We're going to get into this in a second. You'll see why. A request for information, okay, under RESPA regarding loan ownership and possession of relevant contract documents can build a successful challenge to a party's authority to foreclose on a second mortgage. Now, let me say this, ladies and gentlemen. There's some people on the internet right now, and don't you believe any of them. I'm just saying. There are people on the internet right now that will say because of some thing that they believe they have, you pay them for this information, and they'll tell you why you don't even have to pay your first mortgage now legally. Don't listen to it. People have lost their homes over this information. Don't listen to it at all. Okay? So they're scammers and they're getting your money. And as a matter of fact, any company, if you're in the midst of a foreclosure and companies are out there and you do some research and you're trying to find a company that says, we stop foreclosures. Okay? Keep this in mind. Because of what we put up earlier, okay? Let me get my notes here, okay? The Truth in Lending Act and CFPB, all right, the Consumer Finance Bureau, say that people cannot collect money up front to help you to stop a mortgage. They can only charge you once they do. Most of these companies are fraudulent, and they seem like they're associated with governmental agencies because of how their website looks, how their paperwork looks, and how they sound on the phone. But if they're asking for money up front, that is illegal. Do not work with them, and you'll find that out when you check out the government websites, okay? And they'll tell you that that's illegal. Don't do business with them, okay? Get a lawyer. I'm just telling you. Don't even mess with them. So under this, you can be raised. Okay, junior mortgages are not exempt from most of the important truth in lending and RESPA provisions, although some requirements do not apply to HELOC loans. Okay, keep that in mind. So here's some of the things that you want to focus in on. Oh, this is good. All right, Regulation Z. All right, that's part of the Truth in Lending Act. Regulation Z, like zombie, saved a lot of people. So get with a lawyer and let them help you to understand Regulation Z there. There's a whole bunch of stuff in there, okay? Regulation Z. That requires owners or assignees of a mortgage loan to inform borrowers of a transfer of loan ownership within 30 days after a loan is sold. Oh, so all your lawyer has to do is say, and listen, this could have been sold 5 or 6 times in the last 10 years, and you didn't even know anything about it. Okay, so you are supposed to be informed every single time within 30 days, every time that paperwork had been sold to another individual. And in most cases, no paperwork was filed, no paperwork was sent out. And this goes away, from my understanding, just because of this. Make sure you check with a lawyer first. All right. And listen, I'm putting out a disclaimer. We are not giving legal advice here. I'm telling you to contact a lawyer about this. But this is good stuff here. This is good to know. Then it'll help you to find the right lawyer. If you can ask some intelligent questions by doing a little bit of research, you will find a lawyer that knows all about this. Okay. Not all lawyers do. Okay, these regulations are discussed in detail, and they'll give you another link here. Transfer of ownership notices must provide specific information that borrowers need to understand their current payment obligations. The failure to inform borrowers of the sale of their loans contributes to the expectation that there is no need to take action regarding an ongoing payment obligation. Your lawyer can argue that. You didn't contact them. They believed they didn't have to pay it. Therefore, because you did not follow the law here, then this has to go away. Okay? Your lawyer can get that and make these things go away. And this information from these government agencies, Regulation Z, has saved a ton of homes. Okay? Let me see what else we've got here. Notice to transfer of mortgage servicing rights. That's more of the same information. Periodic statement. Oh, this one is good. This one is very, very good. Listen to this one. The P.I.L.L periodic statement requirements. Amendments to P.I.L.L, Truth in Lending Act, periodic statement rule were designed to prevent surprise appearance of a long dormant second mortgage together with unexpected claims for years of accrued interest and fees. So not only were they trying to get you to pay off that second mortgage, they were trying to get all the interest on top of that for the last 10 or 15 years. And all the fees that they charge. They were trying to get all of that. So your $80,000 could now be close to $160,000 or $170,000 that they say you owe because they added all the interest and fees on. Watch out for that. Listen to this. Okay. Okay. Under the rule, servicers must keep borrowers informed about the status of a second mortgage, including whether it has been charged off or reactivated for collection, as well as who currently owns the loan and how to contact appropriate parties for up-to-date information. The rule requires heightened periodic statement disclosures when the loan is in arrears. In other words, they have to send you monthly statements. You should have known that you had a second mortgage out there that had been revived. They should have sent you monthly statements and showed where you either ignored or couldn't pay the monthly statements, and then they can foreclose. In most cases, they're not sending out monthly statements because some of these companies are like LLCs. They're not big companies at all. These companies are run out of somebody's bedroom. They bought up a bunch of mortgages, and now they go to court. They hire, listen now, they hire somebody to collect for them. And then if you believe them, you will pay the money. And they went out big time because you didn't challenge what they were talking about. You didn't know about the fact that you needed to get monthly statements. So if your lawyer can prove all of that, it can save your house. So listen, I need you to see this. Okay. Here's number 5, contract-based claims and defenses. Here's number 6, defenses and claims based on state UDAP statutes. There's a bunch of information here on this site. Get that library link. All right. Do we have that? Did we put that in there? 12 ways to fight foreclosure on zombie mortgages. Let me see. Did I have that in here? I think I do. Yeah. How to fight. What are zombie mortgages and how to fight? Let's make sure that we put that in the give that link out one more time so people can see what that is. Okay. Ooh, do I not have it in there? Okay, let me copy this. Maybe I didn't add that. Okay, what are zombie mortgages? You want this link. All right, here you go. There it is. That's what I've been reading from. And you guys can have that. Okay, this is good stuff. We're sending that out right now. What are zombie mortgages and how to fight? This is good info. Listen, this was an interesting study for me. And it's getting deeper and above my pay grade to even talk about it anymore, because I am not a lawyer. But this is enough for me to understand that you can fight back on these things. So remember, if you know anyone, or if you are in that position where you had an 80-20 loan, a second mortgage that seemed to have gone away, get prepared so that you can fight back. All right. One of the things that you need, all right, because now I want to tell you this. Because you have legal representation, somebody could be out there that have dotted all the I's and crossed all the T's, and you still owe the money. Somebody could have done all of that. Let's get into some numbers so that you can be prepared just in case you find somebody out there that has picked up your second mortgage and has done everything that they're supposed to do so they can now come after your house. So we're going to go to Mr. Brett Whistle, bring him up again, okay? So that we can deal with this thing. We have a $300,000 home, okay? At that time, it could have been around 4%. We'll leave it at 4%, okay? And maybe you had a modification, okay, to save your home. So to get a modification in some instances, so if your payment was too high back then, they gave you a modification, meaning they lowered your payment. Now, when they're lowering the payment, they may have given you a better interest rate, even temporarily, but that doesn't necessarily lower the payment enough. What lowers the payment, and I see this all the time, you go through the modification process and they give you, look at this, 480 months. Okay? That's a 40-year mortgage. A 40-year mortgage to lower the payment for you. Okay? As you can see, 480 months is 40 years. Now, I tell all of my clients, I don't care if it's 40 years or 50 years or even 100 years. They all pay off in the same amount of time because our program looks at how much you owe, not for how long you owe it. Okay, so don't get discombobbled when you call us and you think you had a 30-year mortgage, but you went through a modification. And because you went through a modification, you still think you had a 30-year mortgage. No, you don't. In most cases, it's a 40 or 45-year mortgage, and you didn't even realize that that's what you were getting. But when you find out, when you get your savings and earnings report, don't get discouraged. We can pay it off in the same amount of time. Don't even worry about that, okay? Don't even worry. So here's what we're talking about. We need to put you in a position where you can prepay, give the bank money when you don't owe it. Give the bank money before it's due. And we're going to show you how you can do that so you don't have to pay all this interest. So more of your money goes to principal, less goes to interest. So in the first year here, look, you pay this loan down by $3,000, but you have to pay almost $12,000 in interest to get it here. So if you can prepay, give the bank money at times when they're not expecting it, then you can save a ton of interest. In fact, if you give them this $254.67 early, you don't owe this $9,999.15 in interest. You get to give them this money for free. Wait till the next month, though. When you give them this money, you have to pay them this. What if you had enough money to pay them 3 of these and save almost $3,000 in interest? What if you had enough money to do that? Okay. What if you had enough money to prepay $3,000? You would get here in just 1 month and save almost $11,000 in interest. You never have to pay the bank. So you're gaining equity faster and cheaper, so that when it comes time for you to go get a HELOC, all right, then you could be way down here where you owe a lot less in a short period of time, and you can get a HELOC for about 80 to 90% of your equity. If you have $100,000 in equity and you can get 90%, that means you can get a $90,000 HELOC. Now, once you get the HELOC and you close on it, does that mean you owe any interest? You owe nothing. You don't owe any interest because you're not using any of the money. It is a revolving debt, and you only pay interest on what you actually use. So if you have the money, if the zombie mortgage comes back to haunt you and is trying to eat all of your equity, and they have done everything legally they're supposed to do, you may be able to pay them off with just the money you have in your HELOC and save your house, because you got your information, you got your stuff together ahead of time. You know, people, what they say is, if you get ready, okay, you don't. If you stay ready, you don't have to get ready. If you stay ready, you don't have to get ready. So get that HELOC as soon as you can, even if you don't need it, and it's good for 10 years. And it may save your house. Okay? Uh-oh. Whoa, my screen just went blank. Did you see that? Okay. Oh my gosh, I don't know what happened, but my screen just went blank. But hopefully we're still on. Are we still on? Okay.
No, you're really frozen.
Uh-oh. All right. I don't know what happened.
Go to commercial, and then you come. I'm gonna take you off stage and come back into the studio.
Okay, let's go to commercial.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
How many want to know how to pay off all of your debt in an average of 7 to 9 years?
You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.
Okay, ladies and gentlemen, we are back. All right, so listen, that has never, I've been doing this 3 years, that's never happened. I mean, my screen just went blank. All right, so we're going to go ahead and share this, get back to where we were. All right, so let's get back to how we can accelerate equity so that you can have access to your equity even if you don't need it. All right. So here is a situation where let me put up some other things that will give us a shortcut to all of this. Okay, shortcuts. All right, I'm going to bring up some shortcuts here, and there we go. Going to bring that up. All right, there's one. Here's another one. And some other shortcuts that'll save us some time in understanding how to build equity faster. That one. And this one. All right, let's open them up. Okay. So you got the basics. You got the basics down. So we're going to bring this over. Okay. This is one that we had a $2 million loan, $2.2 million. I'm just going to scroll down and show you how quickly we help these clients build equity. Over here in the red is how the bank wanted this client to pay back their loan. Okay. Over here in the blue is what we're actually doing. Look at this. They start out here, and a year from now, they only owe 1.8, where they would still owe 2.1 doing it the old way. Look at this. Now they're down to 1.4. Now they're down to 952,000. Now they're down to, in about 5 years, they can have this loan paid off. This is how quickly they can build equity. Okay. Let me see here. What happened to my other ones? I had a whole bunch up here. Now they're gone. Okay, take me off the screen again. Let me go over here so I can put them back on. Okay, because the reason why we have to do that, because I have some names in here I can't let you see. All right, we've got that example. We got that example. We have this example. We even have that one. That one. Okay, there we go. Okay. I'm trying to open up 5 of them. All right, we can bring it back now. Okay, so here's one with just $75,000 on the mortgage, $21,000 in loans, and credit cards, a total of $98,000. This is how much they owe. This is how much they owe. And then the next year, they still owe $98,577 if they do it the bank's way. Look at this. Okay, they still owe. So now watch when we do this. Okay, look how fast it's coming down. Look how fast it's coming down. You can get equity a lot cheaper with our program. Okay, a lot cheaper with our program. Look at that. Okay, and here's what's great about it. We can do it with your existing budget. You don't need more money. All right. In this one, let me show you page 1. Let me show you page 1. Their monthly income. They're not rich. When you know how to eliminate interest, it's a killer. This is how much money they have coming in. Okay, $2,312 a month, monthly income. Their total debt payments are $1,003.06. They pay the rest of their bills with $1,008 a month. They have about $200 left over. This is the only money we can use to attack the debt, the $200 they have left over. Not every month. What the program does is says, take that money and put it in savings until it reaches a certain point, and then take the money out of the savings account, not all of it, some of it, and put it on the debt. What we're looking to find is the least amount of money to put on any one of those debts when the bank's not expecting it, and it makes it impossible for the bank to charge you interest. Okay, so here's the amount of interest that the bank wanted was $40,000. With us, this client is only going to pay $16,000. That's a $23,000 savings. So they get equity faster and cheaper, and then they can go and get their HELOC in just a few years. Come on, Ashley. Was this Ashley Stevie? She says, amazing. She says she is buzzing with excitement. What's going on there, Ashley? Where are you from? Tell us where you're from. Okay. Don't forget, ice10k.com. Go to ice10k.com to get your savings and earnings report today. Let me bring up another savings and earnings report here. Okay. Here's another one. Okay. 188,000. Okay. $73,000 in credit cards. This was, you know what this is? This is our velocity banking example. Somebody came to us with it who used velocity banking, but it got out of control, and they started using up their credit cards and got $73,000 in credit card debt. Can you imagine that? $73,000 in credit card debt along with their mortgage. And by working with us, instead of paying $349,000 in interest, they're only going to pay $97,000 in interest. Instead of 29.8 years to get out of debt, they're going to be done in 7.7. How does this work? Like this. Instead of in the red, paying down the mortgage and the credit card debt like everybody else on the planet, over in the blue is how we're going to do it. From here to here to here. Look how fast it's coming down. When you give money to the bank, more of your, in a way that we prescribe, more of your money goes to principal less goes to interest. We're making it impossible for the bank to charge you all that interest. The interest is what keeps you in debt forever, not the amount of money that you borrowed, not the length of time that you borrowed it, but the interest that's charged, that they discount your payment every single month. Okay. And we keep the discount on your side of the ledger. And look here, we pay off the loan like this. Here's another example. Here's one, an investor that has an 18% mortgage on this $200,000 loan. 18%. Okay. 200,000. Here's how much interest the bank wanted on a $200,000 loan at 18%. 884,000. Came to us. We show them how to pay only 172,000. So we show how to use that 18% loan and make it perform like it was. Let me blow this up for you. That 18% loan performs like it was 4.67%. That's how much interest they're going to pay, as if the loan were 4.67% instead of 18. That's a $712,000 savings. That's 81%. It's an 81% reduction in interest. But what's important is that you see this. How quickly they build up equity for a lot less interest so that they can go out at this point and get a HELOC. I'm telling you, you can get there fairly quickly if you know what to do to preserve your financial security, because you have, listen, you got something in your back pocket just in case somebody tries to dig up something on you and try to take your house. Okay? Be ready for them. Be ready. If you stay ready, you don't have to get ready. Here's another one. $600,000. Okay? Yeah, it's kind of the same story. And we're doing this with the current budget. Their current budget, the one that they have now. You don't need to make more money to make this work, ladies and gentlemen. All you need is to pay less interest. You don't need to make more money. Just pay less interest. How do you do that, Don? We'll show you how it's all done. Make sure you call us today. In fact, I got a little time today. If you just want to call and talk about this, I got a client that's calling me right after the show. But call my office at 256-886-1867. You see it's crawling under the screen here. 256-886-1867, and give us a call and just tell the operator, just leave a message and ask for me, and I'll call you back. Okay, I'll call you back as soon as I'm done. But this kind of thing is amazing once you know how. Once you know how, we'll show you exactly what to do, and our computers do all the math for you. Keep this in mind, ladies and gentlemen, before we get out of here. You don't need more money, and you're not going to be cash poor while you're doing this. Meaning, we're going to take all of your money and throw it at the debt so that you can't have some fun, so you can't go out to dinner, so you can't go on vacation. We're not doing any of that. We're going to put everything into the budget, and you're going to be able to live a great lifestyle, and we're only going to use the money that's left over. Once you save it up in the bank, the program will do the math and say, and then give you a prompt to put the least amount of money out of the bank, not the most, the least amount of money out of your bank to put on the debt that's going to kill the most interest per dollar. That's how leverage works. The least amount of effort to get maximum outcome. That's leverage. Not put more money in when you don't need to. That actually reduces your leverage when you put more money on when you don't need to. Okay? We want to save the most interest per dollar. That's what you call optimized interest cancellation. That's what we're getting into, ladies and gentlemen. So let's see. Miss Ashley says here, I have 2 investment properties and RV. Oh, wow. Okay. Listen, I'll be glad to talk to you about it. Give us a call. But here, this is the last thing we're going to put up here for you. Let's pull this off. Let's go to ICE10K.com. We're almost done here. ICE10K.com. That's ICE. ICE stands for Interest Cancellation Expert. ICE10K.com. When you scroll down underneath ET's picture, click on Get a Savings and Earnings Report. And here's what it says. Get your free savings and earnings report. We calculate for you the month, day, and year you'll be debt-free and exactly how much interest you will save. And folks, we have people with 1 mortgage, 2 mortgages, 3 mortgages. They all pay off in about 7 to 10 years. Listen, that's the average. Okay, that's the average, even if you have more than 1 mortgage. So thank you for, listen, I hope this has been beneficial to you. This was important to me because I believe there are a lot of people out there with these zombie mortgages that are coming back to haunt them. I hope you share this information with a lot of other people. On Wednesday, let me see here. Did I put Wednesday show link in there? Wednesday show link is, where did I have that? Let me see here. Wednesday show. I thought I had it in there. Okay, let me pull it up for you. But we do have the information on Sunday show. All right, it's going to be on success. So while we're putting that up, okay, with Jerry Malcolm, let me pull that up. I'll show you what Wednesday's show is all about. Friday's show is still going to be a surprise. Okay, Wednesday's show is, I know exactly where it is, and then I'll pull it over. Wednesday show, we're going to give you an oldie but a goodie. An oldie but a goodie. It's right here. Uh-oh. Sorry. We don't want to go all that far back. Come on. Oh, well. Doggone it, Don. You think you can run this thing by now? Let me pull this over. All right. So let's pull this over. And Wednesday's show is going to be this one. Oldie but a goodie. There it is. Pay off all of your debt in 7 years. Here it is. Pay off all of your debt in 7 years. That's the show we're going to replay on Wednesday. Friday, listen, we still don't have a subject for Friday, but we'll be able to put it up so that you'll be able to see it fairly soon. But on Sunday, be here for Jerry Malcolm, a success coach. Wednesday, how to pay off all of your debt in 7 years. You're going to love that show. Friday, you're going to love that one too. We just have to come up with a subject. Okay. Ladies and gentlemen, thank you very much for being here. All right. And make sure you make Wednesday's show. Okay. If you enjoyed it, I'm glad you did. All right. See you guys later. Have a great Sunday. Bye-bye. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.